Hi, and welcome back to the Alternative Path Real Estate Podcast. Today we're joined by our guest, Adam Jacobs. Adam is the National Head of Research at Colliers Canada and has spent the last decade in the real estate research and analytics space. Adam, welcome and thank you for joining us.
I am happy to be here. I think we have a lot to discuss.
Yes, that we do. Well, first thing, if you've ever seen you on LinkedIn, it's why Canada. You've posted about it, but hear from the source. Why Canada? Why invest in Canada now?
Yeah, I think a good question. I think we tend to maybe be a little pessimistic day to day. We feel like there's so many problems, and if you read the discussion online or anywhere, it's the politics are terrible, and the productivity is terrible, and the cost of living is terrible. And I think there's a germ of truth to all of that, but we also maybe lose sight of the upside and why there are so many good things here. For me, I'm a big believer in fundamentals, and I think the demographic picture for Canada is always like a huge strong point. You hear it from foreign investors who are maybe looking at the whole planet and all the G7 countries, but even if you're comparing Canada to the US or Canada to the UK, like there's a population growth and demographic story, young, educated, growing population it's just a tailwind for real estate for every kind. We've seen it on the residential side, on the industrial side. Now it's gotten a little disrupted in the last year or two. I think it's pretty clear that that's temporary, and I think you got to believe in the fundamentals, the demographics being the biggest fundamental. So I think we sometimes forget we contend with the cost of growth, and it's complicated and causes problems. But if you look at some other countries, at Italy or at Japan, their problem is the other direction. Like the country is shrinking, and if you start to look at real estate as a long-term investment, and I'm looking 10 or 20 years down the road, and this country is shrinking out of sight, like that's a scary thing. So I think we still have that growth story going for us on the demographic side, even though that's yo-yoed a lot more than usual lately. Usually it's just the single most stable thing. You kind of pencil it in 5, 10, 20 years out and don't have to think about it. It's gone up and down more than we ever expected, but I still think you look at most of the forecasts, and long term it gets back to a sort of stable, normal level of growth, whatever we were at 7, 8, 10 years ago, and that starts to become a big tailwind for maybe certain asset classes more than others, and we can get into that, but just generally, I would say for growth in real estate.
Yeah, let's assuage some fears. I saw it for the first time in Canada's history. The population shrank, which obviously isn't
shocking.
Great. Yeah, it's shocking. Yeah. And now we're going, okay, long term, things are going to turn around. In fact, we're going to get back to our old growth. When do you see that growth kind of returning?
I think it is surprising to see that, especially when you can literally go back 100 years and that never happens. There's always something, government policy or something happening in the world that tends to grow the population. I think this is pretty temporary though, and when we look at this, I won't say Colliers forecasts this specifically, but we look at what macro vendors are saying, and most of them are saying this is a temporary kind of adjustment. We're correcting to the other side, and then in maybe 2 years we're back to sort of a normal level of growth. It's not like all immigration and population growth has stopped. It's just there's been a really quick pullback in some of these areas, like international students. That was a correction that was probably needed, but we're going to see things come back to normal. It's surprising the speed at which it happened. Like I said, demographics is kind of a stable thing you build off. It's very unusual for suddenly we have triple normal population growth. Suddenly we have negative. That's not normally what happens, but I think we're reaching for that equilibrium. I think it's become a little more political than maybe it was 5 or 10 years ago, but I still think there's probably a path back there. Like the country shrinking over time, I don't think is the long-term plan at any level, at the provincial level, at the federal level either.
That's good news, I guess, for the long term. I think no one invests in real estate in the short term or with the short term horizon.
Yeah, even like looking on LinkedIn, it's always so cynical. I find with Canada, I find the noise of how great Canada is often lost. It's nice hearing kind of the great things about Canada.
Yeah, and there's more. I think some of it is sort of taken for granted, like this stability that we all take it for granted. You could say bank stability, political stability. Like look at the rest of the world. Stability is pretty valuable right now. And again, I think if you're an investor, this is a long-term commitment. And honestly, like the investable universe is probably smaller than it's been in a while. I was at a conference and the executive said, I don't want people investing in Canada just because every other country is going to hell. Like I want to win on our merits, and that's very admirable. But I do think there's a story of like there's just a lot of chaos in the world, and there's a stability story here that's attractive. We know there's less volatility. Like you look at markets like the U.S., the highs are very high and the lows are very low. Like it really does vacillate a lot more in terms of the ups and downs, and you hear the more sort of apocalyptic stories of an office building sold for $3 a square foot or something. There's not so much of that here. Like it's a little more contained, and I think we take that for granted, or we feel that that's boring, or maybe it's sort of a negative. It's putting a cap on the upside. But I think the stability is certainly something that I think is a positive if we're zooming out to the sort of global level.
Yeah, even anecdotally, like some of the clients I'm hopefully going to be working with and have talked to about buying in Canada for real estate are very bullish on Canadian markets, and there's obviously some hurdles to get into Canada, but it's where they want to allocate a disproportionate amount of their capital, which is pretty exciting.
Yeah, and not always the case, but I think there is a situation now, like when you see the big transactions from a foreign investor, or even a smaller transaction, like why are they buying into Canada? Because of growth that maybe doesn't exist elsewhere, because of diversification, like Canada, if they're overexposed to Asia, Europe, like Canada is a good place to balance that out. And honestly, I think we take this for granted too. Like we're shocked by the prices here, right? Like we look at industrial rents at $20 or land prices or housing costs. It's cold comfort, but when you zoom out to even higher level, like our prices really are actually attractive. Like if you're looking at Toronto and you're benchmarking it to Amsterdam, LA, Hong Kong, London, we're probably the lowest one on that. And so you see it, to us, these prices seem a little crazy. You see maybe global investor sees this and says, actually, I think there's upside here. Like to us, it's just, we've seen rents go up so much in some areas. We think like this can't continue, but maybe if you're looking at it at a sort of global level, there's actually more runway here than there is in your really expensive gateway markets, your Manhattan, Hong Kong type markets, which are kind of like already at their peak.
I agree. And then kind of segueing a bit to oil and bonds and kind of the global picture. I know our bond market is 70 basis points lower than the 10-year in the US. Like any insight for you on why pivot away, maybe not pivot away, but why Canada over the US as like an investment thesis?
Well, I think probably by the time we post this will already be out of date. I just saw today that price of oil is down $20 from yesterday. Like the level of volatility right now is pretty crazy. Like, and in some ways, real estate's insulated from this more than other areas. I think like the currency market and the bond market and the stock market are responding every 10 minutes. I mean, if you have a 7-year lease, it doesn't make any difference what happened in the Persian Gulf yesterday or what's happening with tariffs necessarily. Like we do have a sort of security with the longer terms and the slower timeline for everything, for development and everything. But I think again, Canada's an oil producer. It's a top 5 oil producer in the world, and generally that is sort of, again, it's on the sidelines. It's not something we focus at, but this is a sort of strange mixed blessing at the household level. It's very painful, like prices are higher and it's pushing rates up higher. I think that's the big concern for us on the real estate side, is just oil prices lead to inflation. Inflation leads to activity from the bank and the bond markets, and then the cost of debt goes up. And we know we're kind of uniquely dependent on debt. Like it's just an industry that can't function. You don't start a landlord business in mom's basement. Like you need to have lending and accommodating rates to make that happen. But we do have lower rates. The conventional wisdom was we couldn't really diverge very much from the US on rates, but we're starting to diverge more than we really ever have, and there doesn't seem to necessarily be a penalty. I think that the fear when that happens is we're going to have lower rates. It impacts the Canadian dollar and other areas. We haven't necessarily seen that, partly because of the strength in oil, I think, which tends to lift the Canadian dollar. So You do have a better financing environment. Like if you look at the rates in the U.S., it's a little shocking. Like they're pretty high. Like even a residential mortgage is quite expensive by our standards. So again, rates feel very high. They're obviously higher than they were 4 or 5 years ago, but we're still in. If you look globally, like the rate picture is somewhat favorable here. I think especially if you're lending in Canada versus the U.S. And since we're just so dependent on debt and lending in real estate compared to other industries, that's important.
Just to tie it back to our last conversation point on the population sort of shrinking. I hesitate to say that because it's small, but that's disinflationary. And then we have oil obviously being inflationary. Do you think we're protected from a rate perspective, at least for the short term?
I am personally skeptical about rate hikes now. There's an announcement next week. We'll see, but I think this is kind of a unique situation. Like they're supposed to hike rates when the economy is overheating. The job market's too hot, population growth is too high, the housing market's getting too expensive. The economy is nowhere near overheating. Like we have an outside problem about oil prices and that driving up the cost of living. But again, I'm trying to be optimistic. But if you look at it from the Bank of Canada, like the labor market's weak, the housing market's weak. We've said population is shrinking, growth is weak. So I don't see how they could look at that and say we need to raise rates to cool down the economy or slow things down. As you point out, like there's actually a lot of things going the other way on inflation. Certainly a shrinking population, a falling housing prices. Those are all going the opposite way. So I know there's some fear that this is going to lead to, you see some stuff in the headlines that it's going to be 3 more rate hikes this year. I just don't see that as realistic. And even not everything is within the Bank of Canada's control. Like raising rates isn't going to affect the fact that there's a conflict in the Persian Gulf and it's impacted the oil market. Like Canadian rates don't really have anything to do with that. So I think it's more the downside problems of, look, gas prices are up 50% from where they were at the start of the year. That impacts households, it impacts savings, it impacts retail, it impacts everything. So I think it's obviously a negative, but I don't see the rate hike story developing necessarily.
So very glass half full outlook. We're going to say the only positive coming out of this is that rates might hold steady.
I think I think earlier there was more of a case for cuts. Even I think you were seeing unemployment drifting up and the housing market dropping, and I probably would have bet more on cuts. Then I think they were pretty clear about we're holding, and now there's fear about hikes. But I guess I just don't see hikes as realistic. I mean, there's already a lot of obstacles, and perhaps it's wishful thinking in the real estate world. But I can't see, if we're so concerned about developing more housing or something, then I don't see how higher rates would help achieve some of those goals. Like, yes, there's the goal of controlling inflation, but there's bigger goals about productivity, growth, investment, the labor market, which all would be very harmed by raising rates. So I'm gonna stake my claim on that one. We'll see. Call me at the end of the year and see how that prediction turned out.
We'll see what happens next week, and we can. Then we might have to edit this.
Yeah, remove that if they raise rates in April 16th or whatever.
Like a voiceover.
Yeah.
Now, pivoting a bit to institutional investor sentiment and kind of activity. For the remainder of this year, if you were to postulate what happens in the future from the institutional perspective.
Yeah, and I pointed out before, like the institutions have really retreated in the last 5 years. Like they used to drive the Canadian investment market. We have a heavily institutional market. Look at our downtown, and you pick every building off the skyline there, and it's going to be owned by Omer's pension plan or something like that. It's unusual, and not all downtowns are like that. But institutions really pulled back for a variety of reasons. Like they were overweight real estate. Their returns in real estate were so good they almost couldn't buy anymore. And they found themselves in a situation where I think we have to be honest and say the returns in real estate are, if you're considering all the asset classes, and I mean all of them, not real, but crypto, bonds, private equity, venture capital, private credit, real estate is no longer the top of the heap like it was probably 5 or 10 years ago. And now we're in a situation where if you're that kind of big investor and you're just looking for returns, like they pivoted to private credit, private equity, some of these other areas, and real estate has just kind of held steady. It's competing a lot more with infrastructure with other areas, but I think there's signs that the institution, they can't stay on the sidelines forever. They are able to be patient in a way that no other investor can be patient. I mean, they can wait out people for an infinite amount of time because of the way they're structured. But I think we started to see last year REITs come back a little bit to the investment market. We've started to see institutions come back to the investment market, and there is a certain copycat nature of these are the biggest, highest profile, most visible investors. And when they do something, they're smart. So I'll do that same thing because whatever they're doing, I'm going to follow along. So I think the fact it's been surprising for the last couple of years where the private investor has taken over the institution, the REIT has kind of sat on the sideline, not transacted as much. But I think that can't last forever, and you start to hear more and more institutions say like we want to allocate to real estate, like pricing becomes more and more attractive. For the story for office, which I'm sure we'll get to, is obviously like completely different than it was 1 year ago. And it's not an asset class that usually moves that quickly. Usually it's more like it takes a couple of years for vacancy to level off and then the market turns a little bit. For us, it's just been, Q3 last year, everything changed. It's a whole new world. So I think there is going to be the momentum of the larger investor getting back in there, whether that's like the REIT or the pension plan. We've seen the large foreign investor play in Canada already, but that's a little harder to predict, I think.
Yeah, we always kind of use the expression like herd mentality. Like as soon as you don't want to be the guy that is first to move the herd, but as soon as the herd moves, then there's going to be a lot of activity again. And anecdotally, I see that from conversations I've had, and it's exciting. So I think there's going to be that movement for the remainder of the year.
Yeah, I think it. Like I said, they're high profile. I also think like the way it works generally is the leasing story develops first, and then the investment story comes along kind of the next year. So, the leasing story is finally good for office after 6 years, and I think like a couple quarters of the good leasing story, and suddenly the investors perk up, and like you said, you don't want to be the first one to buy office, but somebody's going to dip their toe into that. But it doesn't happen the other way. You don't invest and then the leasing gets good. The leasing gets good and then the investment happens kind of the next year. So at the end of last year was in our stats, the best leasing quarter, I think, in 8.5 years for Toronto. So, and it was a long time coming, right? I mean, the market vacancy can't go up forever at some point, but it was the speed with which it turned around. And we have, a bit more of like a big business mega occupier kind of market than maybe Vancouver or some of these other ones. So it really had an immediate effect, and you're starting to just see the sentiment. Like I said, sentiment usually turns kind of slowly, and it takes a while. But this was much more immediate, much more tied to kind of mandates to RTO being like announced at every bank, every government, every insurer, which I think was a bit of a surprise. For certainly a year ago, I was not as optimistic. I thought it's been 5 years. Kind of hard to see what's going to change now. Like hybrid work has settled in, but it just came out of the blue, and we're seeing that change like impact the leasing market right away.
I know like our portfolio has definitely been a beneficiary of these RTO mandates, and we're excited to see both transactions in the office space take place. Did write down a couple of transaction volumes. Year over year, the office transactions are actually up by about 30%. So it's pretty surprising to hear that, there's a bit of, I guess, cautious optimism a year ago. We'll call it. I think that's a nice way of saying no optimism.
Yeah, skepticism. We looked at this recently on the investment side, and like everything's cyclical, right? Office and retail were the ones that were up most year over year. If we'd said that 4 or 5 years ago, that would have sounded like just complete dreamland. We'll never get to that place. Everyone's going to work from home forever. But the cycle seemed to be speeding up. I think it's like those were the core assets 10 years ago. They completely went out of fashion because of lockdown, population growth, e-commerce, all these other factors. And now we're right back where we started. Now, the office is not as large an asset class as it used to be. I mean, we say 30% growth, and that's great. But like the size of the office investment market 10 or 20 years ago was probably bigger than it is now. Like it's come down, valuations have come down, there's fewer transactions, but we're clearly past the really bottom point of that cycle, I think.
That's exciting to hear. They're past the trough. I think everyone's been kind of waiting for that patiently. I guess
I agree, and it's been a long wait. I mean, once it's 5, 6 years of rising vacancy, like I said, it's easy to say it can't go up forever, but it started to just seem like what's going to change this. You hear those stories in the really troubled markets of we're going to start demolishing buildings, we're going to start converting buildings. I always said I never thought that would happen here. I mean, it's just things have to get way, way, way worse. We have to be at 30% vacancy for 10 years before we even begin that discussion, and even then, there have to be incentives for the landlords and everything. Like, it's a long way out. When you read a news article, it's like, let's just demolish half of downtown. Or like, I don't think we're there yet, but it is pretty surprising just how rapidly it's swung back the other way, and how like office has a growth story, right? Like, people, there's always the yield story of real estate, but people want the capital growth story, and that was hard to find outside of in kind of industrial going to the moon. And now you can actually look at office and say, I am buying this at a good price, at a good cap rate. I think what we've heard certainly from like lenders is the financing side of it, office has improved drastically. Like, the challenge a year ago was like, sure, I want to buy office. Who's going to lend me the money to do it? Like, it's just considered way too risky, and not like somebody is going to veto this high up because we don't want to be in office or we're overexposed to office. I think that's come down a lot. Like, I think the lending side, especially for good office, downtown office, starts to look way more favorable than it did even a year ago. And again, lending's an area that usually moves pretty slowly and doesn't adjust drastically. But we just had a lender come in recently, and he was talking about, okay, we've seen some improvement on the lending side of other assets, but the speed of improvement on office is pretty profound.
Yeah,
it's exciting if there's appetite.
Yeah. Well, you mentioned kind of flight to quality. Do you have any statistics about kind of how people have moved to the AAA buildings first, and kind of what is happening with that sentiment? Why everyone wants the best?
Yeah, we've dug into that a fair bit, and certainly the gap between like the top of the market and the rest of the market is bigger than it's ever been. I mean, we looked at this historically, and the sort of the vacancy rates for AAA being near zero and still being double digit in the rest of the market. That doesn't normally happen. Like, typically they kind of move together, and if you look at the market, good market of 8 or 10 years ago, they were a lot closer. But the world of work and office has changed a little bit. Like, there's a huge premium that the commute has become more and more challenging. People live further and further away, and it's not necessarily expected that every employee will come in every day. There needs to be a draw. The draw is better views, better food, better accessibility, better air quality, whatever it is. We see the premium buildings, which are right out the window here, are in huge demand, and from your top drawer tenants. I won't say these tenants are insensitive to price, but there is a certain tenant who's like, I just want the best building in the city, and that's what I want in every city I'm in. Like, Toronto is just one market out of 50 that I'm in, and I want to be in a good building because that's my brand, or that's where I want to be. So there is that, but I think there's also just the access to the path, the access to the train station, to a simpler, shorter commute is just more important than it's ever been. And we talk about this all the time, not just in Toronto, but the challenge, downtown does have some challenges. Traffic, commuting, parking, cost of living, infrastructure. Like, it's frustrating for landlords and tenants because what can you really do about that other than beg the city to make things better or make things faster? But I think just it's frustrating because there's only so much you can do, right? If your building isn't on the path, there's not really anything you can do about that. Now, we do see landlords investing in food and beverage, and investing in lobbies, and investing in a lot of things that, to try to control on the margin and make it more attractive. But I think just the AAA building, aside from being new, is kind of defined by all this connectivity and all these amenities. And that's just more important than it's ever been. Like, it's just harder to get the employee to the office, and the quality of the office needs to be higher than ever. Now, that said, when there's no space in AAA, at some point it trickles down to the next level. Like, people are not willing to wait years for a AAA space as much as they might want it. Like, we're going to see the leasing kind of cascade down to, okay, this building is path connected, but not AAA, or it's one building away from the path, and that's going to be good enough because it has other offerings, or it has a large block of space. But I think, Yeah, we looked at this over time, and like the gap is just larger than it's ever been. It's just the way the leasing market is now, and the combination of some big tenants, some move up leasing too. Like you can look at these towers, and a lot of it is somebody who is in the okay building has the opportunity of a lifetime to go to the absolute best building in the city. Well, you leave some vacancy behind when you do that, and that whatever you left behind is harder to fill maybe than it was 5 or 10 years ago.
Well, even like a couple months ago, I was talking about that contrarian approach and targeting the Class B, and 5 months ago, everyone was like, "No, that's crazy." But now it seems to have some more feet. Like people are talking about it a bit more. At least maybe I'm bringing it up because I like the thesis. But I'd be curious. Do you think that gap is going to narrow soon?
I think it has to. Like it can't stay at this level, and it was AAA was almost its own market. Like and it's a different market because the buildings are new, a lot of them. So pre-leasing, build the building. Well, pre-leasing happened before remote work and before all this. Like it's not a one-to-one comparison to where we are right now. Like a B office has to contend with leasing as it is today. A AAA office, part of the leasing happened 7 years ago or something like that. But I think one of the things we're looking at is like what, like if office investment is coming back, what is going to transact? I think people want to believe that like the $1 billion towers are going to transact. I actually think the B office that maybe was bought 10 or 12 years ago, we've already seen some of these, and Colliers has done some of these deals, University Avenue type thing. A building that was bought in 2013 for $140 a square foot, you're selling it now and you're still coming out way ahead. Like even with office in a tough situation right now, like prices are still ahead of where they were 10 or 15 years ago. So I think there's a sweet spot of maybe some of these B offices that the owners held them for a long time. They maybe don't want to be in that space anymore. And there's always a bigger market for this kind of sub $100 million asset. Like you get above that level, and that's beyond what like a private investor can play in. So suddenly the universe of buyers shrinks really, really rapidly. But in the smaller price brackets, you have a lot of buyers. We've seen owner occupiers, we've seen private investors, we've seen all kinds of people who've never owned real estate before at all are getting into these markets. So I think there is the affordability and the kind of repurposing potential of those buildings, I think is going to be attractive, even if they're not pack connected, even if it's a B asset instead of A.
No, I agree.
Where do you see some of these like trickle down effects, I guess, of people coming back to the office, being in these Class A buildings? Are there going to be more retail focus for more high end food items? Is there more? What about like residential in this downtown core?
Yeah, I think like generally people coming back to downtown is a good thing. I know there's people say they like work from home and they want to keep work from home. I think there's also the bigger picture of just what do we have downtown, and I like you don't have to go far to go to maybe a Buffalo or a Cleveland or a Detroit where it's like that's not the downtown you want Toronto to turn into. Like there's a level of vitality that people want to be here. It's fun. There's entertainment. There's food. There's a place to be that's not just your office. I think we already see it in terms of like I was out yesterday and I was turned away at a restaurant on Wellington because it was full, and I was just sort of stupefied. But there was a baseball game and there were a lot of people downtown. It was a Tuesday night. I was pretty surprised, but I think the sort of urban retail food and beverage has been pretty resilient. I think we've seen that throughout that even the last 5 years, even when retail went through a lot of ups and downs, like there is still the desire for that. You see it as like a very reliable tenant, suburban downtown or everything, but there's still a lot of vacancy downtown, and like we're going to see those knock-on effects of everything retail, entertainment, parking, like all of those things that had really like suffered a kind of once in a lifetime downswing. I think there's quite a bit of room to grow that. It's just they're still contending with it's difficult to park, higher cost of living, like the things that make it harder to operate than it was maybe 8 or 10 years ago are still there, but there is that just tailwind of just more and more people downtown, more and more fuller towers than there were even a year ago, and I think that we are going to see that spill over.
Yeah, it's exciting to see the path be as busy as it once was? Like
Path is very busy.
super often.
Yes, I think it's surprising. It's funny. Someone said to me, "Oh, yeah, this population decline." Well, I certainly haven't noticed it on the GO train
Yeah.
commute or something. Like, there's plenty of statistics which are like, GO train ridership is like near all-time high levels, which suggests, okay, that I think one thing we underestimate is, I think we all know someone who maybe moved pretty far from maybe who used to live in the city and moved pretty far away from downtown. There's a challenge to getting that person back. Not all those people can come back. Like, if you move to Barrie or Cambridge, I don't think you're coming back to work on Bay Street 5 days a week. It's just not possible. But a lot of people maybe move to a farther out suburb, and now the GO train's their only option. And we're seeing it. We've looked at some of the data. Ridership's down for most things. GTC ridership's down. GO train ridership is not down. It's reaching like all-time high levels because more and more people kind of populated the suburbs, maybe not thinking they would ever have to come back. I think that was a fair assumption 4 years ago. It's just the world has changed, and now suddenly that conduit is very crowded.
Now, if I guess whoever listening and they listen to you talk about office, it's going to be clear who you think the winners and losers for the remainder of 2026 are. But winners and losers all asset class. What do you think it is?
I actually, housing is a little down in the dumps. It's had a rough couple years, but I think there's actually still upside on like multifamily is a unique asset class because of CMHC and because of the ability to get very preferential financing and loan terms. There's nothing like that. You can't go build an office tower and say I'd like a 50-year term at 3%. Like, that's not available. That is available for some of these residential developments if you meet this standard and affordability and green and everything. But the rents have come down, the housing market has come down, but if you're looking at multifamily, like, housing is still unaffordable. It's out of reach. If you earn 100K, you can't afford a home in a lot of Canada, and that drives more and more demand for renters. So even though we see, purpose-built rental construction is up, it's up over last year, it's up over 5 years ago, but there's probably still not enough. Like, there's probably still a demand. And again, if we're forecasting forward that, okay, at some point immigration returns, most immigrants rent. They don't come here and buy a house in a major city on day one. It takes some time. Or I still actually think there's some upside, even though, look, obviously the condo market and the residential market are just having like the worst time ever, and there's a lot of pain in that area. But there's also been a big shift away from the condo asset to the purpose-built rental asset, and I think, like, as much as we built, we might still just be getting started in that area. Maybe I'm going against the grain a little bit here, but
it's a cyclical market, though. It's the same thing with office. A year ago was contrarian. Now it seems normalized. I'm sure that will be a conversation we'll have maybe a year or two from now, where people aren't as bullish at it, but it will come back.
Yeah. And to add, I think there's no real shovels in the ground anymore. I don't know if anyone's really adding any more purpose-built rental, or definitely not adding any condo at the current moment. So
yeah, it's hard to see it in the moment, but I think it's kind of like office in a weird analogy, right? For years it was too much supply, no demand. Now we wake up in 2026, it's too much demand, no supply. There's nothing being built. And I wonder if housing could repeat that whole setup of, like, we leave the crane index and there's, hundreds of condos being built, then it all goes to zero, and then the population comes back, and we all are sitting here saying, wait, we didn't build anything. Where's all the apartments for these people? So I think there's that. We haven't talked about retail and industrial as much. I mean, those have been kind of, industrial has been bulletproof forever, but we've discovered that has some cycles too. I always used to say that the market update never changed for industrial. I would just say everything's at record high, occupancy is at record high, rents are at record high, prices, development. It was always at record high. We've come off of that, and as tempting as it is to blame Trump and tariffs, like, it was already happening before that. Like, it just can't go on like that forever. So we've seen a little bit of a pullback. Developments come down a little, rents have come down a little, but again, still a healthy market there, and ones that's evening out pretty quickly. I think retail and industrial just have the big NAFTA Kuzma question mark hanging over their head, and I don't have any specific insight on that, but those Housing, we're going to need housing, and the population's going to grow regardless of NAFTA or whatever. Office is a little less tied to that because it's RTO mandates and what's happening in the job market right now. But I think industrial and retail, there is that question of like, where are we with tariffs, with imports, with Kuzma? What we found is people can't wait forever. My prediction was that tariffs were just going to wreck the industrial market, but that didn't really happen. People found workarounds, or people said, we can't just wait forever to make a decision and get clarity. Like, we're just gonna, if your lease is coming due, you still have to do something. You relocate, you renew, you expand, you walk away, you close your business, something. There's a decision that's required. But I do think that the tariff thing has kind of gone into the background with Iran and rate hikes and oil shocks and all of these things, but it's still a pretty big concern, I think. Retail has been a winner. Like we said, investment volume's up, but retail kind of became this defensive asset, right? It's just sort of, people need it, whether gas prices are up or down, or tariffs are up or down. Like, there is just a certain kind of bulletproof nature to a lot of retail where it's like, whatever's happening, I still need to buy groceries and get my kids shoes and, go to the pharmacy. And there's just a certain level where retail isn't really developed. You have a base of assets that are pretty good in terms of the leasing and rent growth story. And it's weird because it goes through the cycle like everything else, but now retail is considered safe, like not kind of uncontroversial, like lenders like it, investors like it. And it's retail isn't a high-rise product, so it can't really be developed the way things are now with like land prices a lot of places. So whatever we have is what we have, and if you're an investor, that's an attractive situation. Like, you're not worried about them building 3 retail plazas down the road and taking all your leasing because they're never going to build them. So if you have a good asset, you kind of control a whole little market there.
Even so, I think people are going to be taking retail off the market to intensify it. Maybe not in the short term, but that is a real, I guess not concern, but I guess tailwind. See, like, if retail might be more desirable and be less, and everyone needs groceries.
Yeah, and I think the covered land part of retail we've seen a number of times where it's like, you see a deal, the price seems kind of high, it doesn't totally make sense, and they're like, no, this is about densification, redevelopment, housing, but the market is such that land almost can't transact. Like, you can't go to a lender and just say, I want to buy this land parcel and densify it. You can go and say, I want to buy a suburban strip plaza or something with excess land, and I'll figure this out and get this rezoned later. But right now I have an asset and it's generating income and I'm okay. So I think we've seen a lot of those transactions, and you see the private buyer get in on those where they have a longer term, okay, they're going to add a streetcar stop here, or I'm going to be able to get this like changed at the city council and be able to do some things. So there's a flexibility to that. Retail always has like excess parking, low density, and there's a potential to build that up in other areas.
Yeah, it's a great story right now.
Yeah, and I think the focus was last year. I did a panel at ICSC. It was like the collapse of the Bay. This is it. Retail is cooked. It's like the Bay isn't relevant for suburban strip plazas and neighborhood retail and Main Street retail. Like, it's obviously a huge story, and certain landlords have to contend with the like backfill situation there. But I think we're actually going to forget about that pretty quick. Like, it's a massive headline story. This 400-year-old company goes broke, but I think it's sort of like Nordstrom, or you see these big stories. They're really like a drop in the bucket of the overall retail story, which I think is fairly positive.
Even just considering that, like, that feels like so long ago, I guess, for all the noise recently that's happening. But
and even the Bay bankruptcy is like, people were talking about that before the pandemic. Like, that was considered almost inevitable. I don't mean to like take a victory lap or anything. Like, it was a bad thing that it went bankrupt, but it was also something that I think landlords have been talking about since like the 20 teens. Like, it was, the trajectory was kind of downward, and it ends up costing the landlord something in the short term, obviously, but you have an ability to perhaps generate higher rents, perhaps to get like a different retail retail concept in there. People talk about play gyms and pickleball and all of these new sort of like experiential retail things, like the big old bay boxes are great for stuff like that. And suddenly you don't have this tenant that, a lot of the bay leases were like infinite length, into the decades, and the landlord had no flexibility. That's all kind of wiped away. And there's a short-term capital cost if you have to demise this or change it or do something differently. But I think there's actually a long-term. Certainly, we've spoken to some landlords who say, like, this is actually like the opportunity of a lifetime. Like, I didn't think the bay would ever go away. Now I kind of have a once in a generation chance to do something differently here.
Yeah, get creative. Interesting.
I think that's we've talked about the ups and downs. I mean, NAFTA, like, I don't know what's going to happen with NAFTA or Kuzma, but I think it's looming out there. I just have to assume the best. And I maybe a closing comment is, like, I think there's never been a bigger split between like leasing and investment. Investment, it's hard because there's so much uncertainty and there's always something happening, and investment's very sensitive to like doing the deal at the right time, at the right rate, locking in the right loan, getting the right price, getting the right cap rate. And that's so hard when things are but leasing just has its own momentum. Like, leases expire and something has to happen no matter what. Even if you just decide to go fully remote or close your business or something, like, there's just a momentum to leasing where things are constantly turning over. The landlord's in a different situation. The building has been renovated. There's a new tenant that didn't exist a year ago. There's just a lot of momentum there that I don't want to say it's not impacted by the tariffs or the Middle East. Like, it obviously is, but I think less so, whereas investment is just so sensitive to like rates and kind of getting in at a good point in the market because it's such a long-term type of transaction.
Yeah. Well, it's also a leading indicator, as you mentioned. Leasing is. So thank you very much for being on this podcast and being our number 3 guest.
I really enjoyed it. Thanks. I hope to come back one day.